Hi everybody, this is Brad Sewell from Robinson Sewell Partners, and thank you to the Queensland Innovative Sheep Network for the opportunity to talk again on finance-related matters. As this first slide suggests, in finance, when you're dealing with banks and financial institutions, you don't get what you deserve, you get what you negotiate. So what I'd like to do today is give you some insights into how interest rates are set by the banks, so that you get some understanding of that and you're in a better position to deal with your bank, and also finish up with some ideas around dealing with drought and the sort of information you need to supply to the banks. So this second slide that should be coming up is basically built around that there's three farmers at a barbecue, and you know, everyone talks about weather and commodity prices, and sometimes interest rates come up, and typically farmers tend to focus on discussing margins when they get together. And so in this case we have Farmer A, who basically starts off by telling his two other mates that he has a margin of 1.25%, and the other farmers go, well, geez, you know, that sounds pretty good, because Farmer B sort of pipes up and says, well, you know, my bank's got me on 2.8%, and the other two guys are saying, well, geez, you might be paying a bit over the odds there. And then they look to Farmer C and ask him what his margin is, and he scratches his head and says, well, actually I'm on minus 1.5%, and everybody says, well, what does that mean? And Farmer C says, well, someone explained it a number of years ago, but I'm not quite sure, and I don't really know what rate I'm paying all up. The moral of the story of this slide is that margins are irrelevant. They're a marketing tool, because what is relevant is in this next slide is what the all-up rate is. So the Farmer A, who thought, you know, 1.25% margin was pretty good, when you add that to his base rate of 4.65%, he's actually on 5.9. Farmer B, who thought he had quite a high margin and was you know, paying too much, actually has a base rate of only 2.15%, and therefore an all-up rate of 4.95%. And Farmer C, who wasn't quite sure what it meant, his margin, miner's margin on 7.16% base rate, means that he's on around 5.66. So everybody's perceptions at that barbecue around what their margin meant to their business was totally wrong. The guy who thought he had the lowest rate was actually on the highest, and the guy who thought he was on the highest was on the lowest. And these are real rates. I haven't plucked these out of the air. Those base rates are active as of today for some of those banks, and those margins are quite relevant as well. So never be. You should always, when you're looking at what your cost of funds are or your interest rate, look at the all-up rate. That's the only thing that matters. Margins are irrelevant. This figure here, 2.2%, is basically the cost of money to the banks today at 10 a.m. It's pretty much everything over that 2.2% becomes bank revenue one way or another. Now, if you're on 5.5% or 5.2%, or you know, it means the bank's got a gross return of around 3% on top of the money they paid. So this is a critical number, because banks, you'll often be confused by a bank's base rate. A bank will tell you, well, you know, our base rate is 4% and your margin is 2%. Well, the base rate, again, that's a bit of marketing jargon. The cost of funds, the wholesale cost of funds set at 10 a.m. every morning is 2.2% as we speak. Everything above that's gross income to the bank. You've got to take off their wages and a few other things, but if you match up these costs of funds with your total interest rate, you'll see that in a lot of cases the banks are at least doubling their money, if not tripling in many cases. So you know, once you know this figure, you're in a stronger position to negotiate. I'm just going to go through a case study with you, a recent case study of a real-life transaction that I did for some clients, and they have a debt of 2.2 million. Their current interest rate, which is that top line, is 6.8%, and it's on a 3-year term, and that's made up of a base rate of 3.4% plus a margin of 3.4%. So they're on 6.8, or they were on 6.8% all up. We then took their business to tender, which meant that we put their business out to 4 banks, including their existing bank, to pitch for the business. Now, Bank A is actually the existing bank. That's who they're with. They're on 6.8% with their existing bank. We put the client's finances up for tender, and their existing bank came in at 5.54%, which was over 1% reduction. However, 3 other banks pitched for the business. Bank B came in at 5.23%, Bank C 4.93%, and Bank D 5%. Now, you will see that there are some red numbers in these, and this is where it gets even more confusing for farmers, is that you've got base rates and then you've got margins, but some of these margins apply to the limit of the loan and some margins apply to the balance of the loan. Now, the red numbers apply to the limit. So if you can see Bank A's response, which is the existing bank, while they reduced their interest rate by around 1.3%, a large part of the margin is on the limit, the $2.2 million limit of the loan. So regardless of whether the client owes $1 million or $2 million, they pay that 2.75 and the 0.1% on the 2.2 million. Likewise, Bank B had a smaller line fee applicable to the limit of 0.5%. And you can see Bank B actually has 4 components to its pricing. So, this is where complexity and difficulty in understanding exactly what banks are quoting. You can see their base rates are all over the place. You can see their margins are all over the place. It is very difficult for a farmer or any person in a business to work their way through the variables that banks present when they're pitching for your business. Sometimes even for our business that does it 24/7. We've got to really have our wits about us to make sure we understand exactly what each bank's offering. So as you can see in this case, the bank that actually has the most compelling proposition is Bank C, because not only is their interest rate the lowest, 4.93% all up, both their base rate and their margin are only applied to the balance of the loan. So if the client only has $1.5 million balance, that's what they pay interest on. There are no red numbers there to indicate that they are paying any interest rate on the limit. Not only that, the client, that bank has made a commitment of 15 years to that client's business. Look, loan terms are a little bit irrelevant. Banks can, all loans are subject to annual review, but it just means that the redocumentation of the loan wouldn't have to change for 15 years if nothing else did change in the business. Now, just on that note, be aware that most farm loans or agricultural loans, on average, are renegotiated every 3 years, whether it's for property purchase or restructure, etc. So in this case, Bank C is the best bank, both in terms of overall rate and the way the funds, the interest rate is applied. Now on this deal, as we can see, we have current bank at 6.8%, no fees, total cost of funds $149,500. That's on a fully drawn basis, as if the 2.2 was drawn. Bank, which was Bank C, 4.93%. They actually have ongoing fees of $4,750, but the overall cost of funds, interest and fees, is $113,250. That's a new annual saving of $36,000 per annum. Now, the reason I've mentioned the fees is because some clients actually get quite caught up in fees and say, well, look, this bank's got fees, so, we don't want to go with them. But you've got to look at the overall total cost of funds. There's nothing wrong with paying fees if the interest rate that's been offered is that compelling, that together with the fees, it's still a very good proposition. So don't get fixated on fees. Read them as part of the broader package that's been presented. So we have these clients on $36,250 per annum saving. These clients actually did change bank to this new bank and generating those savings, which work out at about $3,000 a month. A lot of other pushback that we get is that clients indicate that they have a great relationship with their existing bank manager, and that's important. That's one of the key drivers of our tender process. It's not all about interest rates. It's about the product. Is the loan type right for the client? Are the fees right? The interest rates? But more importantly, is the relationship right? There is a bit of what people do is they get fixated on a particular relationship with a manager, and they think that manager is the only good manager in the market. One of the areas that we specialise in at Robinson Sewell Partners is ensuring that we know who the good managers are in all the banks, and they're the people that we go to with our tenders. Sometimes we don't go necessarily to the closest manager, and when you're dealing with teams of 4 or 5 agribusiness managers, we know which 1 or 2 within that team are the most experienced and or the best suited to that particular client, both in terms of enterprise and relationship and personality, etc. So it is a bit of a matchmaking exercise. But what I want to tell you from this slide is that your current manager is charging you $149,500 per annum. We're confident that every bank has the ability to give you a manager who's just as good, if not better, from the aspects of experience and relationship, and potentially save you that $36,000. So quite often our clients get a new manager and are just as happy, if not more so, on top of the money they save. Our business by the way, is not about our business, and your business is not about actually making a change. Overwhelmingly, our clients wish to stay with their existing bank, and that's one of our key drivers and outcomes. At the moment, about 80% of our clients are staying with their existing bank, but sometimes, as in this live example, which is real, the clients change because $36,000 a year saving was very compelling, and not only that, they actually ended up with a new bank manager that they were just as comfortable with, if not more so. So there's lots of good managers out there. Just some other mini case studies. Deal 1, 1.75 million, currently at 5.25%. The existing bank dropped down to 4.96, and an alternative bank actually came in at 4.43. The client saved $14,500. They actually changed. Deal 2, 1.95, currently on 6.1. Current bank dropped their rate down to 5.15%, and then an alternative bank quoted 4.76%. And in that particular case, the clients actually stayed with their existing bank because they picked up a significant enough saving. Deal 3, basically, this was a deal. The clients actually didn't have any debt, so their existing bank came in at 4.5, and 2 other banks around the 4.66 and 4.76%. We believe that if there hadn't been a tender, a professional tender, there probably would have been, the rates would have been more typically in the 5 to 5.5% range. So it's all about how you present your information, which I'm about to get onto. But farmers are in a good position regardless of whether you're in drought or whatever. The banks are keen to do business. If your fundamentals of your business are sound, banks can look beyond drought seasons and look at the longer term, and you can still be an attractive proposition. The bulk of the work I do is in pastoral semi-arid areas, and we're still achieving outcomes, good pricing outcomes for clients who are experiencing drought. Stock numbers are down, etc. As far as presenting your information, everybody knows, I don't need to tell you that the 3 key pieces of information are assets and liabilities, cash flow forecasts, and your past financial performance as depicted in your accountant prepared profit and loss statement, etc. They are the 3 key pieces of information, but there are actually 10 other key pieces of information that you need to cover off on when you're presenting to a bank. So typically farmers provide their bank with an assets and liabilities, cash flow forecasts and financials, but when we do a tender, we cover off on things like personal risk insurance, like life insurance. That's a risk determinant in a bank's assessment of financial risk. We talk about make sure that there's no tax office debts, because quite likely some of these matters that we address early on, if they're not addressed early and they come up at the 11th hour, the bank approves a loan subject to these things being tested, and then you fall over these hurdles at the 11th hour, cause quite a significant amount of distress for everybody. So we address what we know are the key fundamentals of a loan submission up front. If there is some tax office debt, we put a strategy up front around how we're going to deal with that. If there's been some bank account underperformance in terms of you might have had a dishonour, a cheque dishonoured, or maybe you've gone over your limit, we address that up front rather than it flushing out, because it can actually derail a deal immediately if it's not addressed early on. So in our credit papers, we cover often around 12 to 15 key areas that need to be covered off on, so everybody knows where they, including the banker, knows exactly what this transaction is about early on. You only get one chance. You can't go in with a third of the information and get knocked back and try to, put more information to the bank and ask them and expect them to change their mind. Banks, once they've made a decision on a deal, they tend not to want to reconsider it for at least 6 to 12 months. So you need to get the presentation right at the start. Just some notes on managing finances in drought, which, I'm in Charleville at the moment, and there's lots of storm activity going on. Still very hard to sort of gauge who's getting rainfall and who isn't, and who's getting the rain, decent rainfall. So there's still plenty of people that are experiencing dry conditions. The keys when we're representing clients, and we do provide ongoing service to our clients. It's not just about a one-off negotiation, it's about ongoing support. But the keys are keep your bank informed. If you do get rain, send the bank manager just a one-line email just saying, got 2 inches or 3 inches or whatever. If you're selling stock, send a sales advice through. Yep, sold some steers for $900 the other day. When you don't inform your bank of how you're tracking, a banker will by default normally expect the worst. So particularly in drought situations, bank managers, if they've got to try and work out themselves what position you're in, they'll generally default to the worst case scenario. So you need to keep them informed all the time of how you're tracking, so that they're not making trying to making those negative assumptions themselves. Keep your cash flow forecasts up to date. If you can see that you're going to hit a bit of a wall with working capital in 3, 4, or 6 months, address that now with the bank. Don't wait till a week before you're about to run out of money on your overdraft before you try to address it with the bank. Get in early. The bank you'll get good credibility around the bank's perception of your management skills if you address those sort of things sooner rather than later. Know and work towards your drought production and finance strategy. So know what you're going to do once the drought breaks. Know what you're going to do if the drought doesn't break. I still have a number of clients holding on to stock, but they've basically said, look, if we don't have rain by the end of February, March this year, we're going to totally destock. So have a plan, stick to it, make sure the bank understands it. Just be, maintaining your awareness around property values. I'm finding some areas people's perception, both in banking and with farmers, is that property values have dropped 20 or 30%. But the evidence, and up until recently, I was a registered real estate valuer. The evidence is suggesting in a lot of areas that values are remaining stable, and in some cases may actually even improve. So don't get caught in a negative cycle or thinking around your values unless there's actual evidence to prove that that's the case, because I'm seeing people quite stressed by their perception of what value is doing because it's dry when it shouldn't be. Presentation is key when you're dealing with your banks. Just make sure you present the information concisely and properly. Now that actually means you don't give the bank too much information. Some of what I'm doing with some clients now, the clients have given me an Excel spreadsheet with there's so many worksheets in the spreadsheet trying to explain how the cash flow works that I can't understand it, and a bank's not going to understand it. You need to ensure you don't give the bank too much information or too little. So the back of the envelope, way too little. You know, a 60-page submission, way too much. So you've got to get that. You know, bankers are short of time. They, you know, they're just like the rest of us. They, if you give them too much info, you'll be put to the bottom of the pile. And keep working with your trusted advisors, and that's people like professionals like accountants and ourselves, your government-based advisors in the Department of Ag, and any of the people that you confide in from a professional and a personal perspective. You know, maintain contact with all those people, and you can work your way through these situations. So anyway, that comes to the end of this webinar. Thank you for your time. Basically, if you'd like to talk and have a chat, then you know, within about 20 minutes on the phone, I can give you some valuable feedback on your business, and then if we think it's worth meeting up, then another 120 minutes or 2 hours on farm and a cup of tea is all I need. We don't charge for our preliminary assessments of clients' positions. We're more than, and we're on the road constantly, so there will be a point in time during any 4-week period where it's likely I'm going to be close to where you're based and have the capacity to drop by. Just have an informal chat, look at some of your numbers and give you some feedback. So thank you very much, and all the best for the year. Bye.